Hey everyone, and welcome. If you're an investor, you totally know the feeling, right? You score a big gain, but then you see that shadow looming, the tax bill that comes right along with it. But what if there was a way to seriously shrink that bill, a sort of tax loss harvesting 2.0, if you will? Today, we're going to dive deep into a really powerful strategy that takes advantage of a strange little quirk in the tax code. And yeah, it creates a massive opportunity for those who know about it. But it might not be around for long.
This is the classic challenge of investing, isn't it? Every single dollar you make in profit has this little asterisk next to it because you know a piece of it is already spoken for by the tax man. It's not just about making smart picks, it's about actually keeping as much of your hard-earned money as you legally can.
So how are we going to tackle this? Here's the game plan. First, we're going to break down the tax problem itself, get right to the heart of it. Then we'll look at the classic strategies smart investors use to fight back. After that, we'll get into the big, annoying rule that trips most people up and reveal the one asset class that, for now, gets a total free pass. We'll even walk through a practical playbook for 2026. And finally, we'll look ahead and see why this awesome advantage might just have an expiration date.
All right, let's kick things off with Section 1, the investor's tax problem. Look, before we can even talk about the solution, we have to really understand the problem. For any serious investor, taxes aren't just some chore you do once a year. Nope. They are a constant, invisible force that's always trying to drag down your portfolio's performance. And it all comes down to this one thing: capital gains tax. The idea is super simple. You buy something, it goes up in value, and when you sell, the government wants a piece of that profit. That $10 gain you see on the screen? Yeah, that's not all yours. A chunk of it goes straight to the IRS, which means your actual take-home return gets smaller.
But what if you could legally and ethically slash that tax bill? This brings us to a well-known strategy that savvy investors have been using for decades. This isn't about hiding money or anything like that. It's just about being really smart with your losses. So, let's talk about tax loss harvesting.
Okay, at its heart, tax loss harvesting is basically about turning your losses into a weapon. Every single investor has positions that are down. It's just part of the game. TLH is the strategy of intentionally selling those losers to officially realize that loss on paper. And why would you do that? Because it gives you a super powerful tool, a tax deduction that you can use to cancel out the taxable gains from your winners. The process is really just a simple three-step dance. Step 1, you find an investment in your portfolio that's in the red. Step 2, you sell it. That locks in the loss, makes it official for tax time. And then step 3, this is the magic move, you use that loss to cancel out a gain you've taken somewhere else. So a $10,000 gain gets wiped out by a $10,000 harvested loss, and suddenly your net taxable gain is zero. Pretty cool, right?
Now, if it were that simple, everybody would be doing it all the time. But there's a catch, and it's a really big one, designed specifically to stop people from gaming the system. This brings us to the infamous wash sale rule, which is a major hurdle for anyone investing in traditional stocks and securities.
The logic here is actually pretty straightforward. The government basically said, whoa, hold on a minute. We'll let you claim a tax loss, but you have to genuinely be out of that position. You can't just sell your shares of some big company to book a loss for taxes and then buy them right back 1 second later just to keep your same investment. That would be having your cake and eating it too.
And they put a number on it, 30 days. The wash sale rule says that if you sell a security at a loss, you cannot buy back that same stock or something substantially identical within 30 days before or after that sale. If you do, sorry, the IRS says that loss doesn't count for tax purposes. This is huge. It means stock investors have to sit on the sidelines for a full month, maybe even missing a big rebound, just to get that tax benefit.
So that 30-day waiting period is the critical restriction for most investors out there. But what if I told you there's an entire multi-trillion-dollar asset class where that rule, well, it just doesn't apply? This is where the whole strategy goes from interesting to absolutely fascinating.
And here it is, the big reveal. In the United States, the IRS classifies stocks and bonds as securities, but it classifies cryptocurrencies as property. That one-word difference in the tax code, it changes everything. Because of that classification, the wash sale rule that completely handcuffs stock investors does not, I repeat, does not, currently apply to digital assets like Bitcoin or Ethereum. Just stop and think about what this means for a second. A crypto investor can sell their Bitcoin at a loss, claim that loss on their taxes, and then buy that Bitcoin right back 60 seconds later. They get the full tax benefit, they never really leave their position, and they completely avoid the risk of missing a huge price jump during that 30-day waiting period.
It is a pure, incredibly powerful tax optimization play.
Okay, so that's the theory. It sounds great on paper, but now let's put it into practice. It's one thing to talk about a loophole, it's another to actually see the dollars and cents. So let's walk through a real-world example using the 2026 tax year.
First up, let's just quickly look at the 2026 long-term capital gains tax brackets for a single person. You can see for most people, those investment profits are going to get taxed at either 15 or 20%. For our little example here, let's just assume our investor falls into that main 15% bracket.
Okay, let's set the stage. Imagine you've had an amazing year. You invested in Ethereum, it did really well, and you decided to cash out some profits, realizing a $20,000 capital gain. Now, normally with a 15% tax rate, you'd be looking at a $3,000 tax bill on that gain.
But at the exact same time, you're holding a position in Bitcoin that, because the market's been choppy, is currently showing a $20,000 unrealized loss. It's just sitting there in your portfolio, a sea of red. You still believe in Bitcoin long-term, though, so you definitely don't want to get rid of it.
So here's the play. You sell your Bitcoin, instantly harvesting that $20,000 loss. Then, just moments later, you buy the exact same amount right back, so your position is totally restored. Now, when it's time to do your taxes, you've got a $20,000 gain from Ethereum and a $20,000 loss from Bitcoin. They completely cancel each other out. Your net capital gain is zero. That $3,000 tax bill, poof, it vanishes, and you never had to give up your Bitcoin position. That is the power of this strategy.
Now, I know what you're thinking. This sounds almost too good to be true. And that, of course, leads us to the final and most crucial question: how long can this possibly last? As digital assets get more and more woven into our main financial system, while the regulatory ground is shifting right under our feet.
Just look at this timeline. It shows a really clear trend toward more oversight. We're seeing new laws for stablecoins. Starting in 2026, a big international agreement called CARF kicks in, which means more global data sharing. And this is the big one. For that same tax year, brokers will have to start reporting crypto sales directly to the IRS on a brand new form, just like they do for stocks. The Wild West days of crypto taxes? Yeah, they are coming to an end, fast.
So what's the big takeaway here? Well, while the law hasn't changed yet, you can kind of see the writing on the wall. The trend is undeniably toward more regulation, more rules, more transparency. And regulators, they hate gray areas. And this is one of the biggest ones left in the US tax code. It's probably not a question of if this crypto advantage gets closed, but when. So to wrap this all up, let's recap the absolute essentials. 1. Tax loss harvesting is a key tool for cutting your investment tax bill. 2. The wash sale rule is the big roadblock for stock investors, making them wait 30 days. 3. As of right now, that rule does not apply to crypto, which creates a huge strategic advantage. And 4, given how fast financial rules are changing, this unique opportunity, it probably has an expiration date.
And all of this leaves us with one final and really important question. In a financial world where the rules are constantly in flux, who's ultimately in charge of your wealth? Is it the regulators, or is it you? Knowing the rules of the game, using them to your advantage while you can, and just generally taking ownership of your financial journey is more critical than ever. The responsibility? It rests with you. Thanks for tuning in.